This is a presentation I'm excited to do because I am in this exact phase of life. There's so much that we may or may not know going into our 20s and 30s, and only half of it's financial, right? But the financial stuff really does matter. And the things that you begin to do in this season of your life are going to be particularly impactful as you continue on in adulthood and begin planning for retirement. So I'll continue on my presentation. I will have this disclosure slide, just sharing with you that these are general ideas and concepts. They are not specific personal advice for you. You should always talk to someone who knows your situation directly. All right, so just a little bit about me before we get into too much of the content. My name is Damaris Gingerich. I have been a wealth advisor at Brand AMG for a little over a year, but I've been at this company for 7 years, started right out of college, and have been on quite the journey professionally. I earned my certified financial planner designation, and I have just really grown a lot in my career here, and I'm excited to use this expertise that I have now to help other people in this age group. There are a couple of other pictures up here. So my family, I am married to Jake, and our daughter is Olive. She is 18 months, and she is just the best thing that's ever happened to us. She has her good days and her bad days, but she is overall just a delight, and we love her so much. So that's a little bit about me. Now we'll get into some of the content. So the big table set that I want to follow here is the benefit of beginning to save early on in your career. Now, it's got to be balanced with other priorities that you have, but this first slide that we're looking at here illustrates the difference that it can make to begin saving for retirement 10 years earlier versus 10 years into your career. So this illustration, these are kind of going to be funny assumptions, but it assumes a $40,000 salary, working for a period of 45 years, contributing 12% to your retirement savings, and earning 8% on average through the market return. What's really shocking here is the person who began saving 10 years earlier ends up having $1 million more, over $1 million more at the end of this experience. So while there are certainly things to balance and lots of other goals that will be competing for your time and attention, beginning to save for retirement when you are younger is a huge, huge, huge win. This is due to the power of compounding interest. The money that you earn in the markets continues to compound over years, and that really starts to become a big deal when the balance gets higher. So I thought for today, it might be helpful to introduce to you a fictional couple, Leo and Hannah, and kind of apply some of the things that we're going to talk about to their situation. So in this example, Leo and Hannah make about $150,000 a year. They're both working. They're in their later 20s. They don't have any kids yet, but they're kind of considering it. They are renting right now, and they're thinking about buying a home, but they're not sure if it makes sense. They do some level of charitable giving. They also have some debt. So Hannah has a $10,000 plus loan, and Leo has some credit card debt with a relatively high interest rate. And then they also are kind of thinking about monthly budget, prioritizing savings. And then Hannah, also to make some income on the side, she does DoorDash. And she's not really sure how she should be covering that with her taxes. So we'll get into some of the things that they're thinking about and address those. So if we start with budgeting, this is going to look pretty simplistic, but there are only 4 different ways really that you can use every dollar you have. You can use it for living expenses, you can give it away, you can invest it for the intention of growing it, or you can owe it and pay it to somebody else, i.e. the government or debt spending. When we think about budgeting, the reason I wanted to start here is because this is extremely foundational. You cannot understand how much you're going to have to save until you know how much you have to spend. So the best way to start with that is start with your income, and that could be your gross income. It could be your net take-home pay, but starting with your income, pulling out taxes, and then charity. Then you have your fixed expenses. So this would be things that are going to be the same cost no matter what the month is. It could be your rent payment. It could be your debt payment, your car payment, those kinds of things that don't vary from month to month. Then you have your variable expenses. This is probably groceries, utilities, things that aren't the same month to month, but that you still have to pay for. Once you back all of that out, you get to your discretionary spending. Once you're at discretionary spending, hopefully there's something left, but this is where you kind of make decisions on whether you want to take vacations, whether you want to save for retirement, whether you want to save for bigger purchases down the road. And that number is going to be really important to keep track of. Along these lines, I do have a budget spreadsheet that we'll share as one of the deliverables, and also several recommendations for different budgeting apps. Those can be really helpful because they connect to your credit cards and your bank accounts, and it's a really easy way to see in different categories, perhaps where you're spending more than you think you are, or where you're spending more than you want to, or maybe where you thought you were spending more than you actually are. I really feel like a budgeting app is a great way to get a handle on your spending, even if it's not something that you need to check on and use every month. It's really good to get a baseline. So in the next iteration of the budget conversation, we have to consider what to do with the money that is left for discretionary spending. So this kind of has two parts to it. The first is that you need to have an emergency fund. An emergency fund is what you're going to dip into when something goes wrong with your car, or when something goes wrong with your house, or when you have some unexpected hospital bills that you have to pay, or when you get asked to be in a wedding and you have to go on a bachelor trip or a bachelorette trip. That's going to be kind of the unexpected things that you didn't know about. You should be planning for things that you can know are on the horizon, but when something comes up, the emergency fund is where you want to go. Now, a lot of people have varying balances in their emergency fund. The standard rule of thumb is if you have a couple, so in our example, we're working with Leo and Hannah, and so there are two of them. They're both working right now, which means that they probably don't need the same reserve in their emergency fund as somebody who's single, or somebody where they've got a couple but only one spouse is working. And the reason for that is that when you've got two people who are working, it is unlikely that both of them are going to lose their job at the same time, right? Hopefully that doesn't happen. So you have the emergency fund, and for that you probably want to have around 3 months worth of expenses. And that's 3 months worth of expenses that you need to live, not 3 months worth of going out to eat and going to see movies and going on trips. It's really just 3 months of the bare bones stuff. Again, if you have one spouse who's working, one spouse who's maybe staying home or not working, then you can feel more comfortable to have 6 months in case that one working spouse loses their job. So the emergency fund, crucial. You do not want to move into investing money before you have a solid emergency fund, because the worst case scenario there is that you begin investing money and then you either have to pull it out at a penalty or when the market is down. That is not ideal at all. So once you've got that in a good spot, then you can begin to think about other things. So the next place to go, and maybe these two are relatively similar on the priority list, is you've got the 401k. I'll get more into 401ks in a little bit, but the 401k, your employer retirement plan, they will most likely match that at some level. So If you don't contribute at all, you are likely losing out on free money. So if they're going to match 100% of your contribution for the first 3% of your salary deferral, then you probably want to do as much as you can to get that full match. With a 401k, you can obviously contribute more than that, but that's kind of the base level of where you definitely want to start. The next thing that you'd be thinking about, kind of in concert with that, is debt payments. So in our example, Leo had some credit card debt and he's paying 19% on that. 19% is really high. Like if you could find an investment that would pay you 19% returns, you would be thrilled. You want to work on eliminating that high interest debt just as quickly as you can. So in the example from Leo and Hannah, they're going to want to think about, yes, maybe getting the 401k match, but then also really prioritizing paying down that higher interest debt. Once you get past that stage, maybe you don't happen to have any high interest debt, but then you're beginning to think about, okay, so what's on the horizon for us? In our example with Leo and Hannah, they are also thinking about potentially buying a house eventually. And this would be something that you do need to forecast. The other thing that you might think about is a shorter term goal like a vacation or maybe some kind of big purchase that you want to save up for, like a piece of furniture or something that's going to take a little bit of time, but not necessarily be the level of magnitude of like purchasing a home. In that instance, that might be something that has a certain timeline set with it, but it also might be something that just has a, hey, we kind of want this, but it can happen when it happens. So those are the things that you begin to think about after emergency fund, 401k, paying down high interest debt, and continuing to make payments on lower interest debt as well. There are also two other things to keep in mind with that. One is forecasting. So the idea of being aware right now, maybe renting an apartment or renting a house is perfectly appropriate. In a couple of years, is that still going to work? So beginning to keep in mind what might need to happen and then working backwards from that and saving up for those longer term goals. And then also, I was asking around in our office and one of my team members recommended that the splitting your paycheck into different accounts can be really helpful too. So you might go in and update your direct deposit where 10% of your money goes to the to an account where maybe you're using that for certain purposes and the rest of it goes towards your day-to-day living expenses and all of those other things. It can be just an easy way to force the discipline of saving for the future, and that can be a really helpful way to not even give yourself the option to spend. Some people are like that, some people aren't, but that can be a helpful tool. As we continue on, just a couple of things to talk about in regards to student loans. So we were talking about Hannah in our example. She has about $10,000 left on her PLUS loan, and she's got about 4.2% interest rate on that. So she's going to have to pay that, and it's going to be, I did kind of the math behind that, it's around $100 a month. And with student loans, you want to make sure you're very clear on what your interest rate is, what your minimum payment is, your repayment terms. You also want to keep in mind that as your income potentially changes, you might have more that you can put towards debt. When we look at debt from a purely math-related standpoint, a lower interest debt payment or debt obligation might not feel as urgent to pay off. So in this example, we said, Leo, you really need to work on this 19% interest rate credit card. That's going to be so important. But there's also this other loan that Hannah's got at 4.2%. That's probably a little less urgent to prioritize because, again, the interest rate's not as high. But there's also a really big mental weight that comes from being debt-free. And I don't think anyone who's paid off a loan a little early has regretted that feeling. And so in a situation like that, there might also be some thought to obviously get rid of the high interest debt, and then maybe can we roll those payments we were making on that into the student loan and pay it down faster. Again, it's going to be different in everybody's specific situation, but those are just some things to keep in mind with student loans. So now we're going to talk about saving for big purchases. In our example, Leo and Hannah are thinking about maybe buying a house eventually. Some of us are in the phase of life where our cars are on their last legs and we might need a new car soon. Some people are in the phase of life where they're thinking about getting married. And those are all potentially big expenses. I want to talk a little bit about the home savings and purchase. This is a really interesting chart that I saw showing that it is harder to buy a home than it used to be when you're a first-time home buyer. I think a lot of us have felt this anecdotally. We kind of look around and we're like, man, it doesn't seem like there's anything out there, and what is out there is really expensive. That is proven to be true by this data. So since 2010, the rate of first-time home buyers has declined from 50% to currently 24%. So half of the people. It's really kind of interesting. But that just goes to prove that it may not be appropriate for everybody to be buying their first home in the way that maybe it felt like it was when we were watching our parents go through this, or when our parents were growing up. We kind of have this idea that we need to be doing the things that our parents did, and the reality is that sometimes we live in a different environment than our parents did. So to continue on, there are some helpful rules of thumb when it comes to renting versus buying, and those are the overall debt ratio, so total debt ratio, and then there's the housing debt ratio. These are pretty good rules of thumb, but I would say they're also a little bit aggressive on the taking on debt side. So if we were to look at this example for Leo and Hannah with their annual income of $150,000 a year, they have $12,500 gross income on a monthly basis. Now that's before taxes, that's before all the other stuff. That's kind of what it works out to. If they were to follow these rules, their max housing expense would be $3,500 a month. And the max total debt would be $4,500 a month. I worked through these ratios for myself because I do happen to be more of a conservative person. And I think where I ended up and where me and my husband were comfortable with was spending quite a bit less on a percentage basis on housing expense. We still bought a house. It's certainly possible to do that, but one of the things that I think is really important to communicate when you're thinking about renting versus buying is you have flexibility when you're renting and you have more stability when you're buying. For certain people, one or the other of those could be more compelling. A house can be a long-term investment, but only really if you're willing to stay there more than 3 to 5 years. That's the rule of thumb. So if you're the kind of person who's still moving around and making different choices about where they're going to settle down, buying a house might not be the right thing for you. The other thing, and this is, I think, what people don't realize until they buy a house, and this has sort of smacked me in the face too, when you buy a house, you are responsible for fixing the things that go wrong with it. I had a client call in the other day, and he was just letting me know that he needed some money to replace his windows and his doors. And it wasn't a lot of windows or doors, but it was going to be $15,000. I thought to myself, yep, that's what happens when you own a home. So it's more than having room in your budget for a mortgage payment. It is having room in your budget to also save up for the roof that might need to be replaced, or the yard work that needs to be done, or the floors that you want to replace, because you are responsible for doing those things when you own the home. So just some things to consider for Leo and Hannah. I would certainly say they probably want to continue renting until they're in a better situation with their debt, because they're going to have more monthly cash flow to put towards a mortgage payment, and that's also going to allow them to save up for the down payment. A lot of us know this, the kind of rule of thumb for a down payment is 20%. That's where you begin to avoid additional payments because you put down less. And on top of that, you can buy your first home with less than 20% down payment, but it will increase your monthly mortgage cost. And um, there's just something about putting a little bit more down that can make you feel a little bit better about that big purchase. So those are some things that Hannah and Leo should probably be considering. The next thing I wanted to go through is credit scores. So credit score, we hear it all the time. I don't want to spend a ton of time on this, but I do want to highlight the most important things that go into your credit score. Credit score becomes particularly important again when you are trying to qualify for things like a mortgage. Having a good credit score can help you qualify for a better mortgage rate. That can be really helpful. So the two biggest factors are your payment history. So do you make credit card payments on time? And then the next one is the amount owed or the overall debt ratio that you have. So you have a credit limit. If your credit limit is $10,000 and you are consistently putting $10,000 on your credit card and paying it off, well, that's not going to look like a particularly good ratio. But if over time you ask them to increase your credit limit and you're only utilizing 3,000 to 4,000, 5,000 of that at a time, you're going to have a pretty decent ratio. So those are the big things that impact the credit score. One of the other things to keep in mind is the length of credit history is also important. So you might be super, super responsible with making your payments, but you've only had a credit card for 2 years. Well, there's not a long history of you making those payments responsibly. So that will also be something that plays into it. It's not the biggest factor, but it does play into it. And this is why we often tell people you don't want to close the credit card that you've had the longest, even if you don't use it particularly often, because that will shorten your credit history, which can cause your credit score to go down a little bit. I would say a lot of people misuse credit cards. Some people can be very responsible with them. They are a tool just like everything else. You can use it wisely. Nothing wrong with opening one that gets you travel points and taking advantage of that. So the next thing to begin talking about is retirement savings. So Leo and Hannah, they're in their later 20s. They're kind of trying to figure out, should we be thinking about retirement? Well, unfortunately, yes, because the best thing to do is to start early. Like we talked about with that beginning slide, starting early can be the difference between having a lot more and not. When there's a consistent funding of retirement accounts, even when you're not saving amounts that feel really, really crazy, allowing that money to begin to earn money on itself and continue to compound, it's an extremely powerful tool. It's really hard to overstate how important starting early can be. One of the rules of thumb is saving around 15% of your income towards retirement. Again, all of this has to come after the appropriate emergency fund, making sure you're addressing your debt payments if you have them, but saving for retirement, like I said, better to start early. So the other item here is using tax-advantaged accounts. I'll get into this a little bit more when we talk about the 401k and get into the difference between traditional and Roth, but there are different types of accounts that you can save into for retirement, and those can make a big difference on how you are taxed later in your life. There's another rule of thumb here on the slide, aiming to save 25x annual expenses. Won't spend too much more time on that. The big thing is to start saving early and save what you can. So we'll address the 401k a little bit. I saw a meme a little while ago that was somebody starting a new job and they said, well, they asked me if I want to sign up for my company 401k, but I've never run that far. The 401k is not a race. It is a employer-sponsored savings plan. You can save $23,500 into that from your paycheck deferrals. A lot of us might not be in the place where we're thinking about saving that much into it, but it's often designed as a tool where your employer is beginning to help you save for your own retirement. It used to be that lots of companies had pensions and you would work there for 40 years and then they'd pay you out a set amount every month. Those are really rare now, and the 401k has sort of replaced that. So they're designed with a matching contribution. Usually it's something around, 100% of the first 5% of your salary that you save, they match that. All this to say, you don't want to leave free money on the table. Now, the other thing to know about the 401k, particularly with the employer match, is that those are going to oftentimes be contingent on some kind of vesting schedule. So at my company, for example, we have a 6-year vesting schedule. So the company was making those employer matching contributions for me up until I had been here for 6 years. If I had left, some portion of that employer contribution would not have come with me when I rolled my plan over. So again, just something to be aware of. The plan dictates what that vesting schedule is. Sometimes you have to be there for 3 years to get any of it, and then it all vests at once. Sometimes it's gradual over time, but that's how the vesting schedule works. You can also choose whether you want to make your paycheck deferrals to the traditional 401k or the Roth 401k. And I would say, generally speaking, as a rule of thumb for people in our age bracket, you want to be contributing to the Roth option in your 401k. The traditional option can be appropriate for some people, but the Roth option is going to be really compelling, and I'm going to get into that in a second. If you leave your current job, you can take your 401k balance with you. So everything that you've contributed, that's your money. It's coming with you. You roll it over either into your new 401k at your new employer, or you can open an individual retirement account, an IRA, and roll it in there. But that money comes with you. It may be that you weren't fully vested in the plan, and so not all of your employer contributions come with you, but you will certainly take your fully the balance that you've deferred. That will come with you when you leave. Let's talk about Roth versus traditional funding. When we talk about Roth versus traditional, you can have a Roth 401k, you can have a Roth IRA. IRA stands for, like I said, individual retirement account, and that's one that you can go out and open on your own. You don't need an employer to sponsor a plan or anything like that. The traditional IRA or traditional 401k is differentiated by the way that the dollars are taxed. So with the traditional dollars, you are putting those contributions in before you pay taxes on them. So you don't pay any tax, you end up putting more in the sense that maybe if your total contribution was going to be $500, you put $500 straight in instead of paying tax on the $500 and then contributing it. But at the end, when you are retired, older than 59 and a half, and beginning to pull that money out in retirement, you will then be taxed at whatever your current tax rate is at that point. Directionally speaking, taxes are probably going up. So whether you have higher income or not in retirement, you might be paying more taxes at that point. With a Roth, you pay tax on that money first. So you put the dollars in after you pay tax on them, and then hopefully they're invested. They grow over a very long time period. And then when you're pulling them out in retirement, no taxes due. Again, I cannot overemphasize how much of a game changer that can be for somebody, particularly somebody who is wealthier and ends up retiring with a decent amount of income. It can be a real game changer to have an account that is tax-free at that time. And not just a game changer for that fact, but game changing in the sense that you had all of those years where those assets were growing and compounding and growing upon themselves, and then you never end up paying tax on that money. Why pay taxes on money if you don't need to pay tax on it? So the one thing I will say within the 401k, obviously you can only contribute up to the max deferral each year. And that's around $23,500 this year. If you open up a Roth IRA, you can only contribute $7,000 or $8,000 if you're over age 50. So there's a little bit of a cap on that, but it's a wonderful tool when you can take advantage of it. The final thing I'll say about the Roth IRA is that you cannot contribute to that unless you have household earned income. So you have to be making money, and then if you made $3,000, you can put $3,000 into the Roth IRA. for that tax year. All right. Just want to get in here to account types. We talked about the Roth IRA and the traditional IRA or the regular IRA. But the final account type that we haven't talked about is a trust account. It can also be called an individual account, a brokerage account. There are lots of different names for it, but the primary thing that I want to address is the way that it's taxed. So with an IRA, you are saving that money specifically for retirement. With a traditional IRA, you can't pull that money out until you're 59 and a half without paying a penalty. With a Roth IRA, you do pay some penalty if you pull out some of the money early, if it's the earnings. But all this to say, those are really accounts that are intended for retirement in the longer time horizon. With the trust account that I'm talking about, or an individual account or a brokerage account, like I said, they can be called different things. But you have the balance in that account, and then you go and invest it. Say you bought a share of Apple and it increases $100 over the time period in which you own it. Well, if you go to then sell that share of Apple, you have made a gain of $100 and you are going to have to pay tax on that gain at that time. So the $100 is going to be taxed either at 0%, 15%, or 20%. And it just depends on where you fall in the income tiers. For the most part, it's going to be 15%. So you're dealing with tax that you pay right now on any sales, any trades that you make, or you're dealing with tax later when you pull the money out in retirement for the regular IRA, or no tax in the future on the Roth IRA. So those are the different account types. Now you might be wondering which one's the best. There are different options and there are going to be different considerations that you have. But for the most part, it's actually really good to have a balance of all three of those different types of investment accounts from a taxation standpoint, because it gives you options in retirement. So you probably wouldn't be upset if you had a bunch of Roth dollars, but also you might be prohibited, or you might be less interested in accessing dollars in a Roth IRA or a traditional IRA versus dollars in an individual or brokerage account. That might be a little bit more of an easy thing to just balance when it comes to the taxation over time. Keep moving. Talk about life insurance. Everyone's favorite topic. We don't like to think about dying, but it is a possibility, and it could be something that impacts you and your family. In the example that we've been talking about with Leo and Hannah, they don't have any kids yet. And I think when you have kids is when you start to think about what would happen if you died. So they're maybe not in that phase yet, but that's not to say that they shouldn't have some kind of life insurance. So there are a lot of people out there who will try to bill life insurance as an investment. Our firm's stance is that life insurance is not really best treated as an investment. It's best treated as something that protects you against risk. The risk is that you die and that your earnings are not factored into the family household equation for the rest of, your kids growing up or your spouse's retirement or whatever it happens to be. So the questions to ask are going to be, who depends on you? Do your kids depend on you? Does your spouse depend on you? Do your parents depend on you? And if not right now, is there someone who might depend on you in the future? The other thing to address is the fact that you might have some coverage through your employer. So a lot of times an employer will do maybe 2x salary. So you'll get life insurance coverage. If you die, they will pay out 2 times your annual salary to whoever your beneficiary is, and then you will have that coverage. But if you leave your employer, you're not necessarily going to be able to continue that coverage. So that's a risk too. So we have a little risk and needs analysis here. For Leo and Hannah, in their example, they are going to want to think about getting policies now. this is going to maybe sound a little counterintuitive because we just said they don't have any kids yet and they're just kind of figuring out what their life looks like right now. But generally, the kind of life insurance that makes sense for people in their situation is going to be term insurance. So with term insurance, term life insurance, you just go and you buy a term policy. Maybe it's 20 years, maybe it's 25 years, maybe it's 30 years. And if you die before that time period is up and you paid your premiums, then you will get the death benefit, or your beneficiaries rather will get the death benefit because you'll be dead. So that's a really it can be a very cost-effective method of getting life insurance, and it's very simple. It's easy to understand. It's not billed as functioning as something it's not. It's just a really easy, simple way to protect yourself in the future. We don't sell life insurance, but there are plenty of online options that you can find. There are also plenty of brokers. It's probably, if you're going to go through a broker, a good idea to look for somebody who's not affiliated with a certain company, but somebody who's independent and can go find you the best deal for your situation. But back to the reason why life insurance can be important at this stage of life. And the biggest reason is because the premiums are a lot cheaper when you're young and healthy than they are when you're older and less healthy. So if you begin a policy sometime in your 20s with no major health issues, it's probably going to be pretty affordable. I think I got a policy when I was in my early 20s that was probably $20 or $30 a month for the premiums. At this point, it probably would be a little more expensive for me, but nothing that's so prohibitive that you couldn't do it. So it's a really easy way just to get it taken care of and out of the way. And then the specific slide that we're looking at here is designed to show coverage for certain risks. So this would be, say Leo and Hannah end up having some kids and they say, well, our big risk is that Leo ends up making more and he dies early before the kids get to college, and we aren't able to save, and Hannah has to take time off of work because she's grieving, and how are the kids going to go to college? Well, if you ended up getting a life insurance policy to cover that risk, then you wouldn't be so worried. So maybe you go out and get an initial policy when you're 25, and then maybe you're 30, you're having kids, you're thinking, hey, we need a little more coverage, but maybe not for as long. And that's where you can begin to think about stacking policies. Don't have to get fancy with it. Really, just having some coverage and getting it when you're younger is the thing to begin thinking about. So, taxes. Hannah and Leo had a question about their taxes, which was, hey, Hannah's got some DoorDash income, and DoorDash isn't necessarily withholding taxes from that. She's just getting those payments outright. What should she do about that? In those situations, it's probably easiest to address it with your employer withholding. So if you work a traditional 9-to-5 job where your employer's withholding taxes from your income, maybe you just make sure you increase that a little bit to cover the extra outside income that you have. That can be a really easy way to address it. The risk that you go through with not paying taxes throughout the year on outside income is that you will get hit with an under withholding penalty by not paying taxes throughout the year on the income that you have to pay. I'm not a CPA, not a tax expert, so I don't want to get too much farther into it, but it can be important to plan for that, because if you don't plan for it, then you might be hit with a nasty surprise at tax time. So don't want to spend too much time on tax planning, but I just wanted to share some of the things that can be words that we throw around a lot in relation to taxes, but that might not make a ton of sense until you see it. So talk about sometimes above the line deductions. These are deductions that you get whether you are taking the standard deduction or you are itemizing. So if you make contributions to an HSA account, which we'll address a little bit later, if you contribute to a traditional IRA or a traditional 401k, you can also deduct those contributions. I will just say that does not dissuade me from my previous recommendation that most younger people should be funding a Roth 401k instead of a traditional one. Some student loan interest payments can be above the line deductions, half of your self-employment taxes if you had those, and some other stuff. So you take those off the top, and then you get your adjusted gross income. Then you determine whether you're going to take the standard deduction or the itemized deduction. With the new bill that was just passed, the standard deduction will continue to be higher, and that usually means that most people are going to end up with a standard deduction. If you're itemizing, it's because you have either significant charitable contributions, maybe really, really crazy medical expenses, or a big house with a lot of mortgage interest, or a lot of state and local taxes. Those are kind of what go into the itemized deductions that you might take. Once you pull off the itemized deductions or the standard deduction, whichever is higher, that gets you to your taxable income. Then you figure out what your tax rate's going to be. So this is where we look at tax brackets. Now we've got 24 and 2025 on here. Obviously, we're kind of thinking about 2025, and these are the brackets and the way that they work. So the first 11,000-ish dollars you're not really taxed on of income, and then you get into the next bracket where you're taxed at 10% between there. Then you move up into the 12% bracket, then you move to the 22% bracket, 24%, so on and so forth. So the big thing to understand here is that even if you fall into this range where you're making above $206,000 and you are paying 24% on that, you are still getting the advantage of those lower tax rates on all the income below that. So you've got the 22% bracket, you've got the 12%, you've got the 10%. So your marginal rate is the rate that you're paying on your top dollar of income. Your effective rate is all of those rates combined together, and that's going to be lower. Don't want to spend too much more time on this. Again, I'm not a CPA, but it can be helpful to understand how your taxes are influenced by the level of income you have and how much you're actually paying. Again, this is just at the federal level. This is not state taxes. Every state has different taxes. All right, so we're doing pretty good on time, but one of the other things I wanted to get to is estate planning topics. This might be like, whoa, we talked about life insurance, we're talking about estate planning, like we're in our 20s and 30s, right? But it can be really important to start thinking about this, especially when you get married and begin to have kids. So if you are a single person and you pass away, sure, people are probably going to be sad. But you might not necessarily have someone in your life where you're like, wow, I really hope all my money goes to them. When you start to have those people, that's when you should start thinking about estate planning. And there are different ways to do estate plans. There are plenty of online tools that make it pretty easy once you know what you want, and then you can go to an attorney. Attorneys tend to be more expensive, but they are going to be more specialized and more able to deal with any level of a complicated situation. So the basic documents are will, a power of attorney. You might have a medical power of attorney. There's also going to be a trust document that you might have as an option, and then guardianship documents. So guardianship documents are going to be really important for somebody who has kids or one kid, more than one kid. That says, if I die, what happens to my minor child? And that can be really hard to think about. I know when I was doing my documents, it was very hard to think about that, but it is a decision that's better made by you than by the courts. And so it's good to designate somebody as a guardian in advance of your early passing. The other thing that you're thinking about with these estate documents is who can make decisions for me if I'm incapacitated. That's where the legal and healthcare power of attorney come in. That says, if something happens to me where I'm incapacitated, unable to make decisions for myself, this person can make those decisions for me. And then you also think about a will and a trust. A will says, here's the assets I have and here's where they need to go. Those do have to go through the probate process. So it's going to be administered by the courts. It's going to take a little bit longer, and there are going to be fees associated with the administration of that. A trust document says, hey, here's everything that I've got. The trust, as this legal entity, owns these assets, and this is how they should be disposed of if and when I pass away. And that can be a really helpful tool for somebody who's got a little bit more assets now. Might be wondering, do I actually need a trust? Can I get by with a will and these other documents? And I would say for the sake of having something done, it's better to have something done than to kind of get into the weeds or feel like it's too much of a project and, I don't even understand what a trust is, etc. But it can be good to have that in place, and it certainly is important to get the documents done. So maybe less important at this stage whether everything is exactly perfect, because things will probably change and you'll probably make updates, but it is important to have something in place. We'll also talk about beneficiary designations with this, and this is, say you have a 401k account, what happens to that 401k account if you die? And most of the time, if you have a spouse, that spouse is going to be your beneficiary, but what if both of you die? Well, then you can have a contingent beneficiary. Says if both of us are dead, the account goes to this person. I'm not going to spend too much more time on this, but I will say it's very important to check and make sure you have beneficiaries named, and that will really simplify things for whoever has to clean up the estate if you pass. Again, feels a little morbid, but it is what it is. Last thing, well, one of the other things that I wanted to talk about is a couple of specialty accounts. The first one is an HSA account, a health savings account. You may or may not have access to this based on whether your company offers it and whether you have the option for a high deductible plan. The high deductible plan, your deductible is a lot higher, a lot less of your expenses are going to be covered, but then you get this option to have an HSA. They can be a good savings tool for future healthcare expenses if you can avoid spending that. So for somebody who doesn't have a lot of healthcare expenses and can let that balance roll from year to year and then invest it when it gets to be a certain balance, it can be a really good tool. They are also tax advantaged in the sense that you get a tax deduction when you make a contribution to an HSA. They are not taxable distributions when you use it to pay for healthcare, and it grows tax-free. The other thing to talk about is a 529 account. These are so helpful when you start to think about either maybe funding grad school for you or your spouse, or funding your future kids' tuition for college. These can be used actually for K through 12 education as well as college education. They have a contribution limit in the sense that you can have a state tax deduction. Particularly in Missouri, the plan works this way. If you contribute $16,000 as a married couple filing joint, you can deduct that $16,000 on your state taxes and save the 5 to 6%-ish state tax. That can be meaningful dollars. They are for education, so you can use the balance for tuition, for things related to education like books, lab fees, laptop, things like that. And I believe under the new tax bill that just passed, there are also some expanded uses for these. But they can be a really great tool. You invest them. Again, if you're using it for education in the future, it is tax-free growth over time, and that can be really excellent as well. I've started one for my daughter, but the important thing is to think about also what level of college you might want to fund for your kids. Some parents say, hey, I supported you for 18 years. You're out on your own now. In that case, the 529 wouldn't be so useful. Don't want to spend a lot of time on these donor advised funds. Just know for people who are charitably inclined and tend to do a lot of charitable giving, these can be a game changer for your taxes. So if that sounds like you, look into a donor advised fund and see what it can do for you. And then I wanted to share just a couple of books here that might be helpful reading for people who are beginning to think about investing and also just kind of thinking about what what money means, how they manage it, and just kind of the basics too. So The Uncertainty Solution is a really excellent book for people who struggle with the idea of staying invested or wanting to make moves that are based on what the market's doing. This is just a really excellent investing book. The Psychology of Money is just a good one on how we think about money. The Index Card, super basic book, very easy read, covers basically everything you need to know. Financial Peace University, Dave Ramsey, his whole team, that kind of covers more about managing your money. And I'm sure it has a big element towards debt. And then The Millionaire Next Door, about building wealth over time. So these are some really good options. All right. So thank you for bearing with me as I got through all of those slides. Feel free to submit your questions now, and I will start answering those. So the first question we have is, should we adjust our investment strategy as we transition from our 20s into our 30s? This is a good question. And I would say the big thing with this is going to be, did something change in your life or your risk tolerance or your goals? So if you're starting out, and I know I didn't spend a lot of time on investments, but if you're starting out as an investor, you probably want to stick with low cost, easy index funds or target date retirement funds that are going to not do anything super fancy, just get you a good market return. And you're probably going to be comfortable being pretty aggressive. As you transition into your 30s, it's probably still appropriate to continue on to that same track unless something big changes, i.e., you start to get really uncomfortable taking market risk, or you are maybe thinking that your life is going to change and things are going to look different than they did. But it's probably still appropriate to continue with the same macro allocation as you get into your 30s, because you really need the benefit of the growth from the market when you're at that stage of life. The next question is, at what point should people start thinking about insurance, disability, life insurance? Those are really good questions. It's a hard one. Life insurance, I would say, just as a kind of rule of thumb, when you get married, look at it. If you're in your mid-20s, probably not bad to think about it, but certainly if you're married, you would want to start looking at that. Disability insurance, you most likely have through your employer at some level, whether it's long-term or short-term. I will say specifically for the women on the call, if your company doesn't have a short-term disability that policy that covers maternity leave, that can be incredibly important to look into for yourself to replace that loss of income, if there is any, while you're on maternity leave. Okay, the next person asked, what's the best way to get started with investing if you don't have a lot of extra money, and what should I invest in? So there are a couple really easy ways to get started. I would say if this truly is money that you can put towards retirement, go open a Roth IRA and put money into that. Just kind of find an investment that, again, is kind of a low cost index fund that's going to get you what the market is returning. I don't want to name a specific fund on here, but the Vanguard funds are very low cost. The Fidelity funds are also very low cost, as are the Schwab funds. So within all of those, you can probably find something that's going to be a really good solution. And then the big discipline is just continuing to add to it. Like I've been emphasizing throughout the call, though, you do not want to invest money that you might need to spend on something else that happens. You need to make sure you have an appropriate emergency reserve before you do that. Next question is, what is the biggest financial myth that has gained popularity today, in your opinion? I think it kind of depends on who you're listening to. I think a lot of people have been really interested by the idea of cryptocurrency, and crypto can be really great for some people if you time it exactly right and you get in at the right time and you get out at the right time. It can also be incredibly volatile and a very, very, very risky asset. So I think in that regard, the thing that you want to keep in mind is that sometimes building wealth, actually all the time, building wealth is really done by doing the right things in the right direction for a long period of time. Yes, some people get rich off of a single stock, but that's incredibly hard to do. And it really, if that's your strategy, it's probably not going to work. Okay, so I have quite a few other questions to answer. We'll keep going here. Another question said, how do I know if I'm financially ready to have a child? This is a big one and something that a lot of people in this age bracket are wrestling with because kids can be really expensive. So I would say the things to think about are, what are you going to do when you have a baby? Do you have two spouses who are both working right now? And if so, does one of them want to continue working? Does one of them want to stay home with the child? If not, if both of you want to continue working, then you have to think about whether you can afford daycare. And daycare is a huge range of expenses. Some people pay a lot. Some people don't pay a lot. Some people have grandparents that want to take care of their kids. And all of those can be good options for a family, but you just have to kind of understand that that is going to be a huge line item in your budget. I don't pay a lot for daycare in comparison to some others, but it is a significant line item in my budget. So I would say your baby probably isn't going to cost you that much, but daycare will. So I don't want to go into it too much more than that, but that's one of the biggest considerations is, what are you ready to do with your employment and what are you ready to do with daycare, and can you afford that? Someone else said, thank you for sharing the information. I'm so happy to. Okay, somebody else asked, should I have my student loans entirely paid off before looking to begin investing? I would say no, you don't need to. It probably depends on how big your student loans are, but those are two goals that can exist at the same time. You probably need to think about how high the interest rate is on the student loans, how much free cash flow you have each month. But as I've been saying this whole time, beginning to get something towards retirement savings really early can be extremely helpful. And then one other question, would you recommend paying off debts first, even if the interest rate is low, before pouring money into a Roth IRA, saving for retirement through 401ks at work also? So again, I think some of this is going to be dependent on the interest rate, and some of it is dependent on how it feels to you mentally. But there can be a huge mental weight that's lifted when you pay off the debt. So it's going to depend on the balance of the debt. It's also going to depend on how much free cash flow you have. I would say sometimes the answer is just split the baby, do some towards the debt, do some towards the Roth IRA. Because again, like I've been saying, beginning to get exposure to the markets can be really helpful. These were some really thoughtful and informed questions. So I hope that I answered them to satisfaction. I will kind of give it another second here, but I think that these were a lot of the topics that are kind of facing us as we enter our 20s and our 30s and think about how to prioritize our money. It can really be a huge benefit to make the right decisions at the beginning of your life. And I think everybody who's attending this call probably knows the value of that. And I hope that this has been helpful. So as I haven't seen any other questions come in, I really appreciate everybody who joined. Like I said, we'll have a couple of follow-up resources that will be helpful for you. And I hope everybody found this to be helpful and has a really great rest of their day. Thanks everyone, and we'll be in touch.